There is this famous thought experiment in engineering and business strategy. Imagine you are flying a massive commercial airliner, right? Just cruising along at 35,000 feet.
Yeah, a pretty high-stakes scenario right out of the gate.
Oh, exactly.
Yeah.
And suddenly, mission control radios in and tells you that you need to completely swap out the old, heavy, fuel-guzzling engines for brand-new, high-octane, supersonic jet engines.
Right, which is just insane.
But here's the kicker. You have to do it mid-flight without losing a single foot of altitude.
And without spilling the passengers' coffee in the cabin, I imagine.
Yeah, exactly.
I mean, it sounds like a guaranteed disaster. Most pilots, or if we are translating this to the corporate world, most CEOs would tell you it is completely impossible.
Right, the conventional wisdom is you land the plane first.
Exactly. You land, you secure everything, and then you change the engines safely in the hangar.
But in the hyper-competitive world of healthcare technology, landing the plane essentially means losing your market share. You simply do not have the luxury of pausing your business for a few years to reinvent yourself. Okay, let's unpack this.
Let's do it.
Because today's deep dive is an exploration of a company that is essentially pulling off this exact mid-air maneuver. We are looking at AngioDynamics, specifically unpacking their Q4 and full year 2026 earnings results.
Which we pulled directly from their July 14th, 2026 financial presentation and the accompanying press release.
Right.
And, this really isn't just a routine, dry financial update. Our mission today is to decode how a traditional, reliable medical device company is executing a massive, real-time strategic transformation.
It's fascinating.
We are going to dig beneath the balance sheets and the clinical trial milestones to show exactly how incredibly complex medical science is being translated into accelerated, profitable business growth.
Which means that whether you are investing in healthcare, working in corporate strategy, or you are just insanely curious about medical tech and the agonizing journey it takes to actually make it to patients, this deep dive offers a masterclass.
Absolutely.
We are looking at the blueprint for how a company pivots its entire core identity without crashing the ship.
And to really appreciate the scale of this pivot, I think we have to start with the macro financial picture. Before we get to the cool technology, we need to look at the anatomy of this transformation and establish what it actually looks like in cold, hard numbers for the 2026 fiscal year.
Right. Let's look at the overall scoreboard. So for the full year of fiscal 2026, total sales hit $320.2 million.
Which is a very solid 9.4% year-over-year growth.
It is. But, if you just look at that top-line revenue number, you completely miss the real story. To see that mid-air engine swap happening, you have to look at how AngioDynamics divides its business into two distinctly different segments.
Precisely. They have essentially split the house into two factions, med device and med tech. Now, med device is the legacy business. These are the traditional products, the foundational tools like catheters and basic vascular access ports that have kept the lights on for years.
The trusty old engines.
Exactly. Med tech, on the other hand, is the new growth engine. That segment is dedicated to innovative, highly advanced, procedure-specific platforms.
And the financial performance of those two segments paints a radically different picture. The legacy med device segment grew slightly, up 2.5% to $170.2 million.
Stable.
Yeah, it is stable. It is churning along, doing its job. But the med tech segment, that surged by 18.4% to $150.0 million.
Wow. Yeah, that 18.4% growth is the momentum they are desperately looking for. But here is the statistic that truly illustrates the transformation. Med tech now makes up 47% of their total revenue.
Almost half.
Almost half. And if we rewind back to 2020, when they first began this strategic transformation, medtech was only about 22% of their total revenue.
Going from 22% to 47% in just a few short years is staggering for a publicly traded company. Going back to our analogy, they are steadily ripping out those reliable legacy engines and bolting on these high-octane medtech jet engines, all while the overall revenue, the altitude of the plane, keeps steadily climbing.
What's fascinating here is that this isn't just about chasing top-line revenue growth so the charts look good for investors.
Oh, totally.
The underlying why it matters context here is a deliberate, calculated focus on profitability. Those newer medtech platforms carry significantly higher gross margins.
Right.
For the full year, the medtech segment had a gross margin of 63.6% compared to the med device margin of 46.7%.
I want to pause on that because a nearly 17% difference in gross margin is massive.
This is huge.
That means for every $100 of medtech they sell, they're keeping almost $64 to cover operating expenses and profit, compared to keeping less than $47 on their older gear.
Exactly. You are getting far more juice for the squeeze, so to speak. And this strategic mix shift toward the higher margin tech helped generate a positive pro forma adjusted EBITDA of $13.2 million for the year.
Okay.
Because of this disciplined operational execution, they ended the fiscal year with a remarkably strong balance sheet, zero debt, the flexibility of a revolving line of credit, and $53.9 million in cash.
But wait, if you are a listener looking directly at this balance sheet, you might be terrified.
Oh, because of the GAAP numbers.
Right, because right next to that positive adjusted EBITDA, the company also reported a GAAP net loss of $36.7 million for the fiscal year.
Yeah.
So how can they be celebrating profitability when they technically lost almost $37 million?
That is a crucial distinction. GAAP stands for Generally Accepted Accounting Principles, which includes absolutely everything. When a company does a massive pivot like this, they incur massive one-time restructuring costs.
Like what kind of cost?
Things like facility consolidations, write-offs of old inventory, or legal fees for acquiring new tech. Adjusted EBITDA strips out those one-time, non-operational costs to show you the actual heartbeat of the day-to-day business.
Ah, I see.
So the $13.2 million positive adjusted EBITDA tells us that the core business of making and selling these new devices is highly profitable, even if the structural cost of changing the company's DNA was expensive this year.
That makes a lot of sense. They are absorbing the cost of funding their own evolution. But since this high-margin medtech segment is the undeniable growth engine driving all this,
Yeah,
we naturally need to look under the hood.
we do.
It is easy to say medtech is growing, but what are they actually selling?
Well, the two undisputed MVPs of the medtech segment right now are Auryon and NanoKnife.
Let's look at Auryon first.
Okay, so this is their peripheral atherectomy platform. Atherectomy is a procedure used to treat severe blockages in the peripheral arteries, usually in the legs.
Right, so instead of just squishing the plaque against the artery wall with a balloon, which is angioplasty, Auryon actually uses a solid-state laser to break down and vaporize the plaque lesions.
Exactly.
It is like a microscopic, high-tech roto-rooter for your blood vessels. And the numbers for Auryon are just relentless. It brought in $66.9 million for the year, up 17.7%. But the most impressive part is that this past quarter marked its 20th consecutive quarter of double-digit growth.
5 solid years of uninterrupted double-digit expansion is incredibly rare.
Yeah.
It is a textbook example of successfully scaling a medical technology by winning over physicians one hospital at a time. And then you have NanoKnife, which is entirely different.
Right.
NanoKnife uses a technology called irreversible electroporation, or IRE. The company highlighted this specifically for prostate cancer treatment. NanoKnife delivered broad-based growth, bringing in $33.1 million for the year, which is a 35.2% jump.
Okay, I need to understand this IRE technology because most tumor treatments I know of either burn the tissue with heat, freeze the tissue with ice, or poison it with radiation. What exactly is irreversible electroporation?
That is the perfect way to frame it. Traditional thermal ablation, burning or freezing, destroys the cancer cells, but it also destroys the structural scaffolding of the tissue around it.
Like collateral damage.
Huge collateral damage. It destroys the collagen matrix, the blood vessels, the nerves. It is like trying to fix a faulty wire in your house by burning down the entire room.
Jeez.
IRE, on the other hand, is non-thermal. NanoKnife sends...
That is incredible. And apparently the market thinks so too, because their Q4 for NanoKnife was explosive. Overall, NanoKnife sales in Q4 were up 64.5%, but the standout was a 132.5% spike in capital sales just in that single quarter.
That capital sales spike is crucial. In medical technology, you operate on a razor and razor blade model.
Okay, explain that.
You have capital sales, the actual NanoKnife generator machines, the razor, and you have disposable sales, the single-use electrical probes, the razor blades. Selling the capital equipment means hospitals are making a permanent commitment to the system.
I am going to push back here, though. A 132.5% spike in a single quarter is almost too high.
It is unusually high, yeah.
Right. Couldn't that just be a temporary promotional push?
Mm-hmm.
Or pent-up demand from a backlog? Having cool, futuristic tech that short-circuits cancer sounds great, but notoriously conservative hospital administrators don't just buy million-dollar machines because the science is neat. What guarantees they're actually going to use them?
This raises an important question, and it is the exact hurdle every medical tech company faces when trying to prove a massive sales spike isn't just a fluke. To drive sustainable adoption, you need a very specific two-part formula. You need bulletproof clinical data combined with frictionless regulatory market access. Without both, the machine just sits in a closet.
So how did they execute that formula for NanoKnife?
Flawlessly. First, the clinical data. At the American Urological Association conference in May 2026, they presented 2-year follow-up data from their PRESERVE pivotal trial. This trial evaluated NanoKnife for the focal ablation of intermediate-risk prostate cancer.
And what was the outcome for the patients?
At 24 months, 97% of patients had a PSA level below their baseline value.
That's great.
But here's the number that dropped jaws. There were 0 new treatment failures identified among patients with available follow-up.
Wait, really? 0?
0. Plus, no new device or procedure-related adverse events between the 12 and 24-month marks.
0 treatment failures over a 2-year period in prostate cancer is practically unheard of. That completely validates the short-circuiting approach.
It does.
It proves the treatment is durable and preserves the patient's quality of life.
Yeah.
So that checks the clinical data box. The doctors are sold. But what about the hospital administrators? How do they get paid for performing this?
That is where the regulatory and market access wins come in, which is the second half of the formula. Effective January 1st, 2026, category ICPT codes for IRE procedures in the prostate and liver became active.
DPT codes?
They are created by the American Medical Association. Without a Category I code, a hospital billing department has to manually fight with insurance companies to justify an experimental procedure.
Ah, I see. It gives the hospital a standardized barcode to scan, essentially.
Exactly. It makes billing routine. And to top it off, Palmetto GBA, which is a massive Medicare administrative contractor, finalized a local coverage determination covering NanoKnife IRE for qualifying Medicare patients, which went into effect right after the fiscal year ended.
That's a huge win.
Clinical proof, a billing barcode, and guaranteed Medicare coverage. That is the exact triad required to turn a futuristic concept into an everyday hospital standard.
It is brilliant to see how those invisible regulatory gears turn behind the scenes to generate that massive spike in capital sales.
Yeah.
But here's the thing about a corporate transformation. It is never a straight lineup. While NanoKnife and Orion are cruising at high altitude, another segment of their medtech portfolio is in an absolute dogfight.
Yes, the mechanical thrombectomy business, which focuses on devices that remove blood clots, presents a much more complex picture because the performance here is a mixed bag.
Right.
For the full year, the segment grew 13.4%. But if we zoom in on Q4, overall sales actually dipped slightly by 1.1%.
And when you look at the specific products in this segment, they're moving in totally opposite directions. It is a tale of 2 technologies, AlphaVac and AngioVac. Let's look at AlphaVac first.
Right.
This system is booming. In Q4, it was up 38.4%. For the full year, it grew by over 44%.
AlphaVac is an off-circuit, multi-purpose mechanical aspiration system. Recently, it has seen massive growth because they secured FDA clearance for treating acute pulmonary embolisms, which are life-threatening blood clots in the lungs.
Right.
But the innovation hasn't stopped there. They just received an FDA Investigational Device Exemption, or IDE, to begin the APEX return study.
Right. This study evaluates something called the Alpha Return Blood Management System. And the engineering problem they are trying to solve here is fascinating.
It really is.
If you are a doctor using a vacuum to suck a massive clot out of a pulmonary artery, you are inevitably going to suck up a lot of the patient's healthy blood along with it. It is like vacuuming a carpet. You are going to suck up some of the rug fibers along with the dirt.
That's a great analogy. And in a critical care setting, blood loss is a severe complication. Losing too much blood means the patient requires outside blood transfusions, which carries risks of infection, rejection, and significantly longer hospital stays.
So the Alpha Return system acts like a built-in recycling center for the body.
Right.
It allows the doctors to collect, filter, and then reinfuse that aspirated blood right back into the patient continuously during the surgery.
Incredible, right?
Yeah. By recycling the patient's own blood on the spot, they are aiming to practically eliminate the need for those risky outside transfusions.
It is a significant leap forward in patient safety. But, while AlphaVac is thriving, we have to look at the other side of the coin, AngioVac. AngioVac is struggling. Its Q4 sales were down 15.8% compared to the prior year.
Here's where it gets really interesting. If AlphaVac is the new hotness, the standard corporate move would be to quietly sunset AngioVac, just kill the product and move on.
Right.
But AngioDynamics isn't doing that. They are actively fighting to turn it around using a major clinical trial called the PAVE study.
Exactly. Instead of abandoning the platform, they are using the PAVE clinical study to expand its indications. PAVE stands for percutaneous angiovac vegetation extraction. They are evaluating the angiovac system for the minimally invasive removal of vegetation from the right heart in patients with right-sided infective endocarditis, or RSIE.
Okay, we need to decode that because heart vegetation sounds terrifying.
It is pretty bad, yeah.
In right-sided infective endocarditis, bacteria infects the heart valves, creating these thick clumps of infected tissue and bacteria, which medical professionals call vegetation. If those clumps break off, they shoot directly into the lungs and can be fatal.
And historically, the only way to remove them was open heart surgery. But patients with RSAE are often already severely ill, perhaps struggling with systemic infections or compromised immune systems.
Yeah.
Opening their chest cavity is incredibly dangerous.
So AngioDynamics is taking this struggling angiovac tool and aiming it at an incredibly difficult niche problem where they have a massive advantage. Percutaneous means they can insert the angiovac through a vein in the neck or groin, snake it up to the heart, and vacuum out that infected vegetation without ever cracking the patient's chest.
The FDA actually gave the AngioVac system a breakthrough device designation for this specific use because the unmet medical need is so high.
Wow.
This strategy shows remarkable resilience. They are finding a critical, highly specialized use case for an existing product to expand its total addressable market and revive its growth trajectory.
It is a massive chess move. But we have to bring this all back down to earth. We have looked at the cutting-edge tech, the clinical trials, the strategic market expansions, but all of this research and development is expensive, and they are operating in the real world, subject to real economic forces.
Right, and they are fighting some serious global economic headwinds, specifically tariffs.
Ooh, tariffs.
Yeah, the earnings report explicitly calls out that tariffs created a 151 basis point headwind on their growth margins, costing the company $4.8 million in fiscal 2026 alone.
Let's translate that for the listener real quick. A basis point is 1/100th of a percentage point. So a 151 basis point headwind means that global tariffs on raw materials, electronic components, and cross-border supply chains effectively shaved about 1.5% straight off their total profit margins.
Which is a lot.
Nearly $5 million completely evaporated due to geopolitical trade dynamics.
And management noted they fully expect those tariff pressures to continue at a similar rate into fiscal 2027. Yet, despite absorbing those multi-million-dollar headwinds, their operational discipline relying on the high-margin medtech still resulted in overall profitability on an adjusted basis.
Which naturally brings us to the road ahead. What does fiscal 2027 look like? They provided guidance projecting total sales between $336 million and $341 million. But the breakdown is exactly what you would expect from our airplane engine analogy at the top of the show.
The legacy med device segment is expected to remain totally flat, 0% growth projected. But the medtech segment is guided to grow another 12 to 15%.
They are completely comfortable letting the legacy stuff coast. They are entirely relying on the new medtech engines to pull the plane forward. And they have a massive new catalyst on the horizon to fuel that growth.
Yes, the relief study.
Exactly.
Yeah.
Just recently, the FDA approved an IDE for the relief study. This is going to evaluate NanoKnife, which we know is currently crushing it in the prostate cancer market for a completely different condition, benign prostatic hyperplasia, or BPH.
BPH is a non-cancerous enlargement of the prostate that causes severe urinary issues, and it is incredibly common in older men. It represents a $1.9 billion U.S. total addressable market.
That's huge.
By initiating the relief study, AngioDynamics is trying to take their proven short-circuiting NanoKnife platform beyond the specialized oncology market and into one of the absolute largest, most mainstream markets in men's health.
So what does this all mean? For the listener who has been tracking these margins, these clinical trials, the science of nanopores, and these strategic pivots, why should they care about a mid-sized medical company's 2027 projections?
If we connect this to the bigger picture, what we are witnessing is a masterclass in a company engineering its own survival. AngioDynamics saw the writing on the wall.
Yeah.
They knew that low-margin legacy medical devices eventually become a race to the bottom. They made the agonizing, expensive choice to pivot. They endured the short-term pain of global tariffs, the stagnation of their traditional business, and the immense multi-million-dollar costs of running rigorous clinical trials like PRESERVE and PAVE.
All to build that 47% medtech revenue base.
Exactly. By doing the brutal, unglamorous work over the last few years, they have positioned themselves to reap the high-margin rewards in 2027 and beyond. They have a debt-free balance sheet, multiple growth catalysts in massive addressable markets, and a clear, proven regulatory pathway for billing.
It is truly an incredible journey. In 2020, just 22% of their business was in advanced medtech. Today, it is nearly half. They have completely changed the DNA of their revenue stream, driven by relentless clinical execution. But looking at this incredibly successful blueprint leaves you with a totally different, kind of unsettling thought.
Oh, really? And what is that?
Well, if AngioDynamics is proving that the only way to achieve real profitability and growth is to pivot aggressively into high-margin, software-driven, advanced med tech, what happens if every other traditional medical device company decides to do exactly the same thing?
That is a fascinating scenario.
Right. Hospitals will always need the low-margin legacy stuff. They will always need basic catheters, IV lines, fluid ports, and standard surgical tubing. But if all the legacy manufacturers abandon those basic products to chase the massive profits of robotics and electroporation, who is going to make the essential foundational supplies that keep a hospital functioning day to day?
That's a very good point.
Does this sprint toward high-tech create a massive, dangerous vacuum at the bottom of the healthcare supply chain? It is something anyone watching the healthcare sector needs to ponder as these technologies continue to accelerate. Thank you so much for joining us on this deep dive. We will catch you next time.